Hello, Marc Ostwald from ADM Investor Services International with some thoughts on commodity markets this week, particularly what supply chain disruptions look like and what pricing disruptions look like, and offering some different examples of how pricing can sometimes be just a pure function of short-term factors and some of longer-term factors. My first chart is just a quick reminder of commodity price performance year to date via Reuters Refinitiv. It really emphasizes that a lot of the price moves have been led by the energy sector, but also with industrial metals and indeed livestock chipping in. This all looks very impressive, particularly those ones with gains of more than 30%. But if one looks at my next chart, which is the Bloomberg Commodity Price Index, a 5-year chart, to emphasize that we're really just back in the range that we were in for about 2 to 3 years. And therefore, it's not really quite as significant as people might actually think. My third chart today is the sub-indices of the Goldman Sachs Commodity Price Index. I've excluded the precious metals one because it doesn't really play into why we're having this commodity price rally and just muddies the water. I think it really does emphasize just what a roller coaster ride there has been in energy prices, how prices elsewhere, particularly I think the livestock price movement, yes, it has gone up quite sharply, but relatively to where we were just prior to the COVID-19 outbreak, it's not really been quite so dramatic. My fourth chart is part of the examples chart. It's WTI. As I mentioned last week, this has been going basically sideways for quite some time now. I think the interesting part of this is really what happened yesterday. Yes, rising infection rates in India above all, where we were hoping for a big increase in demand from gasoline because people would be afraid to use public transport. And then on the other hand, what we've had happen is not only that infection rate creeping up, but also the US House panel considering an antitrust case or the antitrust legislation against OPEC, which is a quick reminder to us all that commodity prices are anything but free markets, and there is constant intervention by governments all over the world, and it doesn't matter which one it is. And that's something which is important to bear in mind. My next two charts are something somewhat more obscure. Lumber prices, absolutely on a complete and utter tear, as one can see. I think the first chart is interesting simply because it's a lumber price future premium over the price for the raw materials, which is trees, Louisiana pine. And as one can see, basically trees remain very cheap, even if lumber has got exorbitantly expensive, thanks above all to the house building wave in the States. My sixth chart is to exemplify something else, which is back to our good old friend Keynes, which is about that idea of markets can be irrational for longer than your pockets have the money to maintain your short position. And as we can see, basically, we thought at the back end of last year, we dealt with this problem, only to find that it's actually got that much worse. It's a chart of the front month versus the future month. And it really emphasizes that as much as trees may be in full supply, lumber supply remains heavily disrupted. My final chart is again another reminder that sometimes things just reprice completely. This is the prices for iridium and rhodium, so-called effectively rare earth materials, rare metals, which will go into the production of a lot of electric vehicles and hydrogen fuel cell powered vehicles. And as one can see, these have fundamentally repriced, and they aren't going to be coming back in a big hurry, even if the current moves are actually very overstretched. So a few thoughts this week on commodities. I hope they've been of some enlightening. And speak next week.